Hi, and welcome to the Alpha Mare Academy. And this particular webinar is Keeping Score, How to Increase Your Results and Profits, which I think is one of the most overlooked functions of business owners, and that is managing and measuring their key indicators. Before we get deeply into the content, I want to just give you a little refresher about the Alpha Mare Academy, which is an online portfolio of educational tools specifically for female business owners. So how did it come to be called the Alpha Mare Academy? That has to do with a metaphor from the horse world. In every herd of horses, there is one horse recognized to be the horse in charge, and that horse is always a mare. She's the one that looks after the entire herd and signals them when to move, when to eat, when to sleep, and signals them when to run in case there is danger. She also disciplines the unruly youngsters. So she is the horse in charge, and it's her duty to look after the well-being and the safety of the entire herd. I think this is a great metaphor for leadership for women, because embracing that identity with the alpha mare is a great way to be comfortable with being a leader, because the alpha mare uses her power for the greater good, of the herd. And I think this is so similar to what I've seen in female business owners. They don't want power for power's sake. They want to make a difference and use their power and their leadership for the greater good. So that's why we call it the Alpha Mare Academy. So if you are listening and you are a female business owner, you are a busy woman, so let's get started. Keeping Score, How to Increase Your Results and Profits is about understanding key strategic indicators. This doesn't get talked about enough for business owners, and these key strategic indicators can go by a couple of different names. You can call it key metrics, key indicators. Basically what that means is these are the numbers that you measure, and these are the things that you need to measure daily, weekly, monthly, quarterly, or annually. The key indicators are the signals that will tell you if you're going in the right direction or the wrong direction. It's the information that you need to make good and timely decisions. And I'll take you back to a story about a client that I worked with several years ago. She had been in business about 20 years, had a very successful business. So she'd had her ups and downs, growth spurts and plateaus, as happens in a business. And when I met her, she was in a plateau in terms of revenue. However, her profits had gone down. So I asked her to do a little research and go back and dig into the numbers, and to go back 3 to 5 years and come up with two numbers. What were her labor costs as a percentage of her total revenues every year over a period of 5 years, and to see how that had changed. And then I asked her to go back, sort her customer lists by volume so that she could look at the top 20% of her customers based on volume. Where was most of her business coming from? What did the top 20% of her customers have in common? And wouldn't you know, voila, certain things just became very, very clear to her, and would have become clear to her had she been watching these numbers all along. What she could see very clearly when she put the labor costs as a percentage of the total revenue and looked at that over a period of 5 years is that her labor costs had gone from 22% to 23%, to 24%, and now to 25%. So year after year, her labor costs had been incrementally increasing each year, and that's what was cutting into her profits. But when you look at just the dollar amounts, what are we spending in labor? The dollar amount might not be very might not be very meaningful as a number just by itself. That number becomes much more meaningful if you look at it in comparison to your revenues. The second number that we had her look at, the top 20% of her customers by volume, and to look at what those customers had in common, what she could see was two industries really stood out: the energy industry and sports teams. Now, she sold a product that was applicable to both industries. What she realized, though, is that she had been focusing her marketing efforts on different industries, and she did not have her marketing team very well aligned around industries. Once she realized that the top volume, where she was getting most of her business, was in these two specific industries, she was then able to ask her sales team to focus on those two industries and take advantage of that. And sure enough, the next year, her volume went up and her profits went up. So that's why it's so important to measure key strategic indicators over a period of time. So you may be saying to yourself, excuse me, why bother? Why should I take the time to do this? I have enough on my plate. I've got plenty to do as it is. Looking at these key metrics, these key strategic indicators, can help you spot trends that you can take advantage of and do that very quickly. It can also help you prevent very serious problems that you can avoid if you're current on your numbers. These key indicators can also help you create efficiencies and help you increase your productivity. It also, these numbers help your entire team know the results of their efforts, because there are some numbers that you will definitely want to share with your team. If your team understands, how does this business make money? What has to happen for this business to make money and to be profitable? They can really participate in that effort. Conversely, if they know what eats away at profits, they can make sure that they prevent these specific things from happening. So when we talk about key strategic indicators, we want to make sure that you are measuring the right things. I would ask you to consider 4 things. One is basic financial measures that you would put in place, and that would be your profit and loss, in other words, your income and expense statement, and your balance sheet. Your income and expense statement will show you all the income that comes in and all of the expenses that go out. But you also want to measure non-financial measures, and these would be things like what I was just talking about, where you look at your customer base and where your top customers are coming from. You may want to measure something like customer satisfaction and do that on a regular basis. You may want to look at the number of sales calls your team is making daily, weekly, monthly. That will depend on the nature of your business. If you're in retail, you may want to, for a period of time, measure the number of people that come into your store. If you're doing advertising that has a coupon, you may want to measure the number of people that come in carrying that coupon. So non-financial measures can be just as important as your basic financial measures. Another way to think about key strategic indicators would be short-term measures versus long-term measures. Short-term measures would be something more like an activity that your team does, whereas long-term measures would be something more like net profit or owner equity or the value of your business over time. What numbers do you need to track on a short-term basis? I'll give you an example of that. That might be retail. Many retail store owners who are on top of their business, they will print out what for the week what their sales were every day for that same week the last year, and give that to the sales staff on the floor to make sure that they can try to match and increase that total from last year. So you want to be comparing apples to apples. You also want to take a look at input measures versus output measures. Input might be the things that you do to generate business. For example, you may want to measure the number of new names that you add to your email list every month. You may want to measure if using social media is driving your marketing efforts, you may want to regularly measure the number of new Facebook likes or friends that you get every week or every month, or the number of Twitter followers that you have, if that is an important part of your marketing strategy. I'm using that as an example. Output is what happens as a result of getting the activity that causes the numbers to go up or down, that causes the sales. So output might be, an example might be the number of new customers you get every week, every month, every quarter. Knowing whether you need to measure that weekly, monthly, or quarterly will depend very much on the type of business that you run. The unfortunate thing about key indicators is that there's not just one basic set of indicators that works for every single business across the board. It will depend very much on the industry that you're in, the stage of growth that you're in, and what your key goals are for that period of time. So you have a handout along with this webinar, and this is a great time to take a look at that handout. Let's take a quick review of your PDF that came along with your webinar, and that is called Keeping Score, How to Increase Your Results and Profits, Examples of Key Indicators. Now, we're not going to go over every single one of these bullet points one by one, but I do want to point out a few. In the first section, financial measures, the second from the bottom in the left-hand column is the percentage of uncollectibles. One of the things that we saw when the economy started to get very iffy back in 2008, and gladly it has done a great job of recovering, at least in many geographical areas. But in professional service firms, what we started to see was that not that they were losing customers or losing volume. However, it was more and more difficult to collect on the bills that people owed them. So professional service firms send an invoice and bill their clients and are paid hopefully within 30 days. Whereas in retail, you can't walk out of the store with a purchase unless you pay for it. But it's very different in professional service firms. Another number that I think is very important for almost every single business to measure is your labor costs as a percentage of sales or revenue, because the numbers by themselves are much less meaningful than they can be when they are tracked as a percentage of revenue or of your overall expenses. Another key metric that you might want to measure, this ties back in with your percentage of uncollectibles, would be the number of days of receivables, the number of days that it takes on your books for you to get paid on the invoices that you send. The more you can shorten that, the better your cash flow will be. It's nice to have people owe you money, but if you're sitting with $20,000, $30,000, $40,000 on your books that people owe you, it would be much better if you had that cash in your bank account. And then select certain expenses and measure them as a percentage of revenue. That will tell you, where is your Achilles heel? What is the one expense that if that expense gets out of control, that's really going to eat into your profits? So that's important to find out what that number is for your business. And the last one in that section is a percentage of billable hours actually billed. This is critical for service businesses. If you are a business that bills by the hour, whether you're in web design or perhaps a PR firm, a graphic design firm, any type of professional service firms, you bill by the hours. So if you assume that your employees have, you or your employees have 40 hours in a week, and those are billable hours, what percentage of those 40 hours are actually getting billed to a customer? In other words, do you have a lot of time that's being spent in administrative procedures, or worse than that, time that people are just sitting there, or time that's wasted? So you want to make sure, if you are paying your employees a salary and you only get revenue when those hours are billed out to a customer, you want the percentage of billable hours to be as high as possible. So the next segment is marketing. I think it's very smart for every firm to measure the marketing dollars as a percentage of total sales. Again, it's not just the straight dollars that you spend, it is how does that number become meaningful when you compare it to a percentage of your sales or your income. And I'm using the term sales and income as synonymous right there. It really means the same thing. We had a client one time who was concerned that that her sales were not higher, and she wanted to look at her marketing. And one of the questions that we asked was, what percentage of your budget do you allocate for marketing dollars? She'd been very informal with that and had spent marketing dollars on kind of an ad hoc basis. In other words, if there was money in the bank, she would say, okay, I have a little extra, I'm going to spend that on marketing. But she didn't really plan a specific marketing budget. Well, in retail, it's very common, I mean, the kind of the standard number in retail is that you need to spend 10% of your revenue on marketing. So as it turns out, this person, when she looked at that number, was only spending 3% of her revenue on marketing. So while that might seem like a lot to her, by industry standards, it was really quite under the industry standards. And it helped normalize that number for her so that she could, going forward, incrementally and gradually try to push that marketing number up and test and measure to make sure those marketing efforts were successful. So you may want to measure, in terms of marketing, you may want to measure the percentage of response rate on direct mail, or if you're using email marketing, what are your open rates and your click-through rates on emails? If you use this for event registration, you might want to measure the number of event registrations that you get and measure them as a percentage of the total number of people invited. So you can see, if you want an event with 20 people in attendance and you invited 40 and you got 20, then you know the next time, well, about 50% of the people respond and say yes. So the next time, if you want 40 people at your event, you may want to invite 80 or 100. The next way you can use that number is to ask yourself, well, how can we improve that ratio? If we're getting a 50% response rate, is there something that we can do to get a 55% or a 60% response rate? So it helps you, again, go back to that previous slide where we said it helps you be more productive and more efficient. Let's go down to the next section, which is business development. The first question you want to ask yourself is, what causes sales? And measure that. In your business, in your particular industry, in your particular line of work, what causes sales? We've talked about retail a lot, so that might be marketing or advertising. In many businesses, though, it's not about direct advertising. It may be about the number of outgoing phone calls you make, the number of appointments that you set, or the number of proposals that you have out there. Another very important number for most businesses, would be, what is your average sale per client? So if your average sale per client is $100, what if you could inch that number up and turn your average sale per client from $100 into $110? That could really increase your profitability very quickly without you having to do a lot. Another number that I've seen become very important for businesses is the number of referrals that you're getting. If your business works in a way that is based highly on referrals, it's very important that you track that. Let's go down to operations, to that section, and the example I would use is what are the dollars generated per square foot? If you're in retail, that is an extremely important number to know, because you might be thinking that the way to increase your business is to increase the space that you have, but what you might be doing there is just adding more expense without actually increasing sales. So you want to maximize the dollars that you generate per square foot. Again, we've talked about billable hours as a percentage of total billable hours. If you're in retail, another important number to measure is what is called shrinkage. That is the merchandise that you have in your store that becomes something that you cannot account for. It's either stolen, or maybe it's broken or damaged. You cannot sell it anymore because it has either disappeared or it's in bad shape and you cannot sell it. If you're in manufacturing, an important number to measure would be the days to shipping. How long does it take you to actually produce what you want to ship and get it out the door? There was an article in a business magazine a number of years ago that I will never forget, and it had to do with Dell. Dell was growing, but they were in very, very bad financial shape, and fortunately they had a CFO, a chief financial officer, that really understood how to help the company, because he helped the company understand that what they really needed to focus on was shortening the time between when the order was placed and the number of days it took for them to build that computer and ship it to the customer. Because the way their business worked, the customer would place the order, they had to have all of the raw materials to construct that computer, but they didn't get paid until that order was shipped out. So if that process takes 2 weeks, then they have a lot of their money tied up in raw materials and equipment, but there's no money coming in the door until that order is shipped. So that may not be a perfect fit for you, but hopefully these examples will trigger other thoughts for you about what you do need to be measuring in your business. So I hope that will give you some examples. Let's go on to another important thought about what needs to be measured in your business, and that would be profit per X. Now this is, I will acknowledge, is a difficult number to come to, and please don't be concerned if you cannot figure this out immediately. Every business, though, should have one core number that they measure, and that is, what is our profit per X? Because that's what really drives your business. Here's an example that came from the book Good to Great, written by Jim Collins. And by the way, profit per X is a Jim Collins concept. Walgreens, the drugstore, used to measure profit per store. So that's how they based their growth strategy. If they measured profit per store, then what would make them more profitable would be, you would draw a natural conclusion that they could have more profits if they built more stores. But you do reach a point of market saturation where you can't have a Walgreens every a mile from one another. So they shifted their strategy to profit per customer. What that meant was that they started diversifying their inventory and carrying a bigger selection of goods so that when a person came into the drugstore, let's say to pick up a prescription or for an over-the-counter medicine, they might also say, oh my gosh, I'm out of paper towels, or the baby needs diapers, or I need a little hairspray, or a new lipstick, or a can of dog food, or a bag of Dove chocolates, or a bottle of Fuse to drink, or some ice cream for dessert. So you can see how one thing leads to another, and a customer goes in to spend money on a prescription and suddenly walks out with $50, $60, or $100 worth of merchandise. So they increased the average sale per customer, and now what they measure is profit per customer. And that shifted their entire strategy, because they could have the same number of customers and still increase their profits because each customer had spent more money. So that may not be what you want to measure. It may not be profit per customer. You may want to measure profit per employee. This can be a very important measure for any business, because sometimes we tend to just throw warm bodies at problems and think, oh, if we're busy, we just need to hire another person, and that may not be what you need to do. In retail, as we've talked about, measuring profit per square foot is very important, and if you are in face-to-face selling, measuring your profit per sales call could be just what you want to do. But give this some time and some thought about what is your one core profit per X that you would want to measure. You don't need to force that or feel like you need to come up with that immediately. The point is that businesses don't succeed or fail without clues. There are always clues. It's important simply to know what to ask yourself, and that would be, what results do I want in 90 days? And this will lead you to think about what needs to be measured to know, am I moving in that direction? As you try to determine what your key indicators should be, ask yourself, what results do I want to see in 90 days? What results do I want to see in 1 year? And what result do I want in 5 years? Then ask yourself, what activities cause sales and what activities cause increased expenses? Finally, ask yourself, which numbers make profits increase or decrease? So you're starting with your income and expense statement. Your balance sheet might be important too, because a number that you may want to measure might have to do with debt or the amount of interest that you're paying. Obviously, this is a big discussion for the federal government right now, because a major concern is the amount of debt that the country has, because so much of the country's revenue, our tax dollars, is going to pay interest on the debt. I'm not trying to make a political statement here. I'm really just trying to use kind of a common sense example to help you think about things that would be relevant for your business in terms of what you want, what you need to measure, so that you can go back to your handout, which are just examples, and you may have others as well. But to ask yourself what results you want to see in 90 days, in a year, and in 1 year, in 1 year and in 5 years, and what are the things that are going to happen in your business to get those results, that will inform you and give you clues about what you need to measure in your business. Some of it will be numbers that come from the income and expense statement. Some of those numbers will be activities that cause sales or activities that cause increased expenses, so that you can really dig into your numbers, fully understand what makes your business profitable, share that information with your employees so that you can be more profitable. I would invite everyone listening to this to make a commitment to track at least 3 key measures. And to give you an idea, so that you're not spending a lot of time worrying about it, I would say 3 things that apply to most any business would be any activity that causes sales, probably want to measure that weekly. What are your total expenses as a percentage of total revenue, and measure that monthly. And if you put these things on a graph or a chart instead of just looking at the raw numbers, things will become very clear to you very quickly, because when you look at a line chart or a pie chart, this will become a great visual tool to help you. And then the third thing I think is applicable to most any business is to measure marketing dollars as a percentage of your total revenue. How much money are you spending on marketing as a percentage of your total revenue? So I think that could be a starting point. You may not want to use these things that I've suggested as ideas. You may have looked at that sheet of examples and said, oh, I can see 3 things that are very, very important to my business that I know I want to track based on the direction I want my business to go. But the important thing is, will you commit to measuring at least 3 things in your business and then create a simple dashboard that's updated weekly? I know that you already have a lot to do. You don't need to fill up your day with wasted time or activity that's not going to be informative to you, but I think understanding the numbers in your business and understanding how to keep score will make your business much more profitable if you commit to measuring 3 things for 3 months. And then I hope you'll come back to this website and post a comment about what you've measured and what your results will be. So that concludes our webinar for today. I want to invite you to return as often as you can and as often as you need to the Alphamare Academy, alphamareacademy.com, to connect with me on Twitter and Facebook and LinkedIn. And I also want to mention our signature program, which is the Alphamare Embrace the Grace of Power. That is a 4-session webinar series that will help strengthen you, strengthen the person first, so that you have the underlying confidence and clarity to move forward on some of the tactical business applications that you need to put into place to really grow your business and be a successful entrepreneur. Again, I'm Darcie Harris. Thank you very much for participating in the Alphamare Academy, and I hope that you'll be with us again soon.